and get us kicked off here and share my screen. And everyone should be seeing my screen here. All right. All right. Good evening, everybody. Good evening. Thank you very much for your time today. I just found out that our speaker this evening that was scheduled was not able to be able to join us this evening. So we are going to go ahead and proceed. But what we're going to proceed with is a presentation on the 2024 multifamily outlook, a presentation that I actually gave at the beginning of the year to kick out off the year to help investors, really have a point of view on what things they should be looking out for 2024. But of course, we're going to go through some of our opening remarks before I dive into that. Welcome to the Wealth Mindset and Real Estate Investing Meetup. Just a little bit about us. The Wealth Mindset and Real Estate Investing Meetup is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professional and retirees across various industries. The individuals in the group make a good living and have discretionary income to invest in real estate for its proven wealth building power, but don't have the time, skill set, or network to do it at speed and at scale. This meetup focuses on helping all of us grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing, as well as other proven ways to build wealth through real estate through passive investments. Now, today, this meetup is sponsored by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify their portfolios, add passive income, and get all the other perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities. We get access to from our trusted network of top operators in the best markets throughout the country. Partnering with Red Fox Multifamily makes investing in real estate completely hands-off, allowing investors to add passive income, build equity, and save on taxes, all while being in an investment vehicle that's backed by a hard asset. So thank you for that brief commercial break. Logistically, just a heads up, please mute your lines when you're not speaking. Please also hold your questions to the end if you can. If you have something burning, feel free to shout out. Of course, this presentation is being recorded, and I am actually going to jump into the material for this evening. Does not constitute an offer or solicitation to purchase securities, and this is information only and should not be construed as business, financial, or legal advice. So as always, what I like to do is I like to let people know that if they'd like to connect with me, they can connect with me in multiple ways. I can be reached by scanning this QR code. It'll bring you all of my information. But of course, you can reach out to me via email at Chris@Red Fox Multifamily. I'm also very active on LinkedIn if you want to engage with me there. So for this evening, I do a brief introduction, have a brief presentation and Q&A, and we'll do some virtual networking if time permits. So Red Fox Multifamily, let me tell you a little bit more about what it is we do. You heard it at the beginning of the presentation when I was introducing the sponsor. A little bit more about Red Fox Multifamily. We help people add passive income and get all the perks of real estate investing without having to do any of the work themselves. The way it works is that people partner with us to buy multifamily properties based on vetted opportunities we get access to. When partnering with us, they become what's called a passive investor, which makes partnering with us completely hands-off for them. That also means that they typically get to add passive income and build equity and save on taxes, all while being in an investment vehicle that is backed by hard assets. So compared to the stock market example, the opportunities people partner with are are usually much safer and yield higher returns. And this is a little bit more, just a little bit of background in here. This is information. It is for information purposes only. There's no, we're not selling anything here. There's no offering here. Just providing information, education. A little bit more about me. I'm a pharmaceutical executive with 20 years of experience and with expertise in marketing, medical, and sales operations. And throughout my professional career, I've focused on continuing to grow professionally and grow myself in all aspects of that I could. I am a certified Lean Six Sigma Green Belt. I have my MBA in healthcare management. I have my master's certification in applied project management, and I received my bachelor's degree in communications and public relations from Marist College. I'm a lifelong learner. In fact, at Marist, the mascot of the school is the Red Fox, and that is what we chose to name our company after, Red Fox Multifamily, which is where, in fact, I met my wife, who helped us start the company, and some of the things that we focused on to be able to launch this company, because that's where so many of our relationships really started and helped us grow. And one of the speakers and authors that I follow and really helped inspire me throughout all of this is a person named Jim Rohn. And he said, famously, a formal education will make you a living, but a self-education will make you a fortune. And so, the real estate and investing in my self-education in terms of learning how to become a professional investor and now be able to help others do the same has been a passion of mine, a passion I did not know I had until a few years ago, where I stepped into this space. And here I am presenting to all of you, sharing some background and perspective on what the 2024 commercial multifamily outlook looks like. And so what we're going to do for today, and I'm going to do an abbreviated version in the interest of time, is I'm going to share a little bit about the summary of the U.S. real estate market outlook. Also going to take a look at specifically the U.S. multifamily market outlook, talk about some investment strategies, and then we'll wrap things up. But what I like to do to ground us all in what it is that we're talking about, and you guys probably cannot see my presentation because I'm not sharing. And you should be able to see now. So with respect to commercial multifamily, one of the things that I love to ground people with is a little bit of background as to why commercial multifamily makes sense. And really it dates back to the housing market crash of 2008, which created an economic recession, as we all remember very well. And many homes were foreclosed on, and demand for housing was at an all-time historic low. And many developers that exited the market at that time, or at a minimum, they delayed existing plans to build new housing, and all of those things really exacerbated an issue. And between January 2012 and June of 2021, about 12.3 million households were formed, according to the Census Bureau. And during that same time, only about 7 million new single family homes were built, and which created a shortage of around 3 to 5 million homes, depending on which reports you read. And this number essentially continues to grow higher, even in the current environment where there's been increased development going on and happening within certain markets where you see a lot of construction and development. But even with that added supply in many cases is luxury, Class A housing. It's not necessarily that affordable workforce housing where the real need is. And as a result of that, multifamily is really strategically positioned, and there will continue to be a need, in fact, for housing for the foreseeable future. The demand for new affordable housing, as I mentioned, especially in growth markets. Think about it. We have folks from Tennessee. We have on the call. We know folks that focus in Texas, in the Carolinas, parts of Florida, Georgia, Arizona, and parts, you name it, parts of the Midwest. There are really strong growing markets, and the demand for housing is very real there. Even in major metro areas like where I live here in New York, have a really strong demand for housing, but not enough supply to meet that demand. And so, with the market demands in growth markets such as the Sun Belt, as I mentioned, many of the states that are in the Sun Belt, that factors such as job growth, population growth, the demand for housing, the cost of home ownership, and inadequate development, this will be key drivers for the foreseeable future around why commercial multifamily makes sense and why it's such a strategic investment opportunity for us to be considering. So before we get into that, what we should understand in terms of the 2024 housing market, we need to take an opportunity to understand the 2023 housing market year-end review, which I found pretty remarkable. And the source of the data, the primary source of the data that I looked at when creating this presentation was a Redfin report that I read through, and I used other sources as well, but this was the primary. And so 2023 was actually a difficult year for the housing market. It actually started off with a continuation of negative trends from the end of 2022 and turned into the least affordable year for home buying on record. We all saw it. Everyone that during the 2020, during the pandemic, from 2019, 2020, the 2021 especially, everyone was taking advantage of those bottom basement low interest rates, 2%, 3%, 4% interest rates, people refinancing from where they were, which was already, maybe favorable for them, maybe 6%, 5%, still pretty good rates, but that opportunity to refinance down to a 3% or 4% 30-year fixed interest rate loan, that was very attractive to people, and people pursued that. And then as a result of that, they stayed put in their home. It wasn't very interesting for them to get up and move because they had locked in such a great rate and tapped into some of the equity in their home, and found that opportunity there. And in addition to that, you didn't have a lot of new supply coming on the market, and so it was very competitive for people to rent homes, very competitive for folks to buy homes. You heard stories of people overpaying or going over asking price, and all sorts of crazy stories throughout that time. But with what really continued to build on that, there was an average of over the entire year that the median sales price was higher than any previous year in history, rising from $407,000 in 2022 to $409,000 median home price in 2023. This is pretty remarkable. And then when you look at other contributors to this in terms of rent prices and inflation, what we looked at here was the fact that rent prices remained historically high because, but they stopped short of a new record. You're looking at the median U.S. rent price that hit about $2,050 in August of 2023, matching that record price of 2050 set in August of 2022. And then when you look at that, the price of goods and services, that inflation that we all felt in everything, at about 6.6% year over year in February, just below that 2022 high, that was the second highest inflation level since August of 1982. These were real contributors to a quieter rental market. There was new construction in the apartment industry and fewer new houses forming, which is essentially when two or more people are living together. These all of these things really created a ripe environment for some competition for rentals, single family home rentals beyond just trying to purchase your home. If you couldn't purchase it, you were looking to be able to rent a single family home, which was a very dynamic, very competitive market. And if you weren't able to secure that, you were looking at other opportunities, which we'll get into in a moment. Mortgage rates ballooned beyond 8% for the first time in over 20 years. And we all saw it as the Fed was really interested in curbing inflation and getting it down to its target rates. People really, the Fed was aggressively raising interest rates, and those interest rates, half a percentage point or a quarter of a basis point here or there, continued to increase at each meeting. It seemed like every time the Fed met over that 18-month period, or we were expecting rates to increase, and what that did for would-be home buyers was position them in a really unfavorable position. So now you have a situation where home prices were increasing because sellers weren't moving because they didn't have to. They locked in at those really low interest rates, and they weren't incentivized to really move, and they didn't have to move. And then so they're staying put. There was not a lot of supply going on, and so that demand for housing was driving up the appreciation and value of homes and making that difficult for those would-be home buyers. But then when you add on top a combination of 8% or higher interest rates, that really made it unreachable for some folks, and really putting them in a difficult position about where and how they wanted to live. And so people bought or refinancing from 2020 to 2023, as I said before, and they were not motivated at all to sell. And as of December 2023, the Federal Reserve raised interest rates 11 times since March 2022 to combat that inflation, to drive down that inflation. And reports today are state that the Fed believes, and many prognosticators are out there saying that the Fed has achieved its goal in being able to do that. But at this moment, that's a lot of what people are saying, and so there's some anticipation that the rates may come down, but we will see. The home buyers that are looking to relocate favored sun and affordability. So what this is essentially saying is that a record 26% of home buyers look to move to a different metro. And I'm sure that everybody on this call and everybody listening to the recording know, or someone who knows someone, if you will, that relocated to the South. Maybe they moved to Florida. Maybe they moved to the Carolinas or to Tennessee or to Texas, or maybe they moved to Arizona. It was really favorable during that time for people to just, hey, I'm working virtually. I don't need to be in this high cost of living market. Let me pick up and move and find a place where I can, be, have my dollars extend a little bit further, if you will. And so 2023 was really a difficult year for the housing market. It started with that continuation of those negative trends, as I mentioned, from 2022, and it turned into the least affordable time for home buying on record. However, there were people that were looking to find opportunities to move to, and many of those top migration hotspots were in those sunny, more affordable metros. And even with risk of climate issues, heat and drought, which we heard of the record heat and drought, that throughout the summer, this didn't deter people from pursuing those opportunities. And in terms of housing inventory, it remained well below average. So essentially, what we are talking about here is that the new construction from a 2023 perspective fell as builders were left stuck with this inflated inventory. Sales fell more than 18%, hitting record lows because, again, people weren't motivated to sell their homes when you had such low interest rate. The median days on the market soared beyond 1 month as the market cooled down, and then median days on market, investor purchases dropped at a record rate as well. And so this really created a really tough environment for investors, or for new home buyers, I should say, primarily, who are looking to be able to try and get into their first home or their next home, if you will. Mortgage rates were the primary reason why inventory was so sluggish. Nearly a quarter of all homeowners at the time had an interest rate below 3%, and around 90% of home buyers had rates below 6%. And that would lead many would-be sellers to stay put, to avoid taking on a higher interest rate when they move to their next home. Just not a very strategic move for them. That wealth transfer that they would have would not be wise, and therefore they said, "We'll stay put, thanks." And so, looking at the 2024 U.S. real estate market outlook, and just pivoting here to give a little bit of perspective, that when we think about 2024 now, one of the sources that I used here to be able to help paint the picture as it relates to this market outlook is a report from CBRE. And some of the data that I was able to collect from CBRE talks about the fact that there's an increased chance that the U.S. will avoid a recession and achieve a soft economic landing in 2024. And according, as we're recording this in February here of 2024, many would say that we may have achieved that. And so this is not Chris making any projections, but this is some of the reports that have come out, and some would say that maybe we have achieved that soft economic landing, in fact, but economic growth will slow and downside risks are elevated. The talk about commercial real estate, which is a very diverse asset class, is really important, and I'll go into that in a little bit. But commercial real estate investment activity likely will begin to pick up in the second half of 2024, likely influenced by some of those floating loans and interest rate caps expiring, and loans coming due, and operators of properties really looking to have to move off of those opportunities into other opportunities. And so, and maybe selling or working with banks to refinance out, or whatever the case may be, there are going to be opportunities out there. And it's expected that the second half of the year will be the timing where this begins. The normalization of this hybrid working arrangements will continue to limit the growth of office demand. Anyone living anywhere has seen, that the pre-pandemic, hustle and bustle of cities. Maybe occasionally there's some sites that things may be returning here and there, but office space and vacancies in office spaces are just tremendous. The work from home era is not going anywhere, and even if employers are luring their employees back with mandates to come back 2 or 3 days a week, it still is not achieving the goals of or hitting the vacancy rates in a substantial enough way for commercial office space. And even some major corporations are renegotiating leases or bailing on leases entirely to be able to downsize certain space requirements, or they are some companies, smaller companies, are just saying, hey, we'll have a permanent remote working situation, and we will maybe rent office space on occasion when we need it. That's where things are going now. Retail, on the other side of things, fundamentals are expected to remain strong due to the scarcity of new construction deliveries over the past decade. And so retail, there's been a lot of talk about retail and changing changing retail environment and how we shop and Amazon and Walmart and all the players that we know about that are influencing retail. But and though there is still a space for retail to thrive, and those folks that are in the triple net lease space and all know that very well. But retail looks to continue to build and thrive. Now, when it comes to the market outlook, for 2024, the industrial market, in fact, it looks to be healthy as well. Think about what the report states is that the net absorption is on par with 2023 levels, and you can see again. I just referred to both Amazon and Walmart, which what's really fascinating about these companies or any of these major companies that are out there distributing products throughout the country, they need warehouse space to be able to get those products to us in that 2 days or 1 day or less when we want it, to be able to improve the customer experience and improve the quality of the service. So this industrial push and warehouses and all of those things are going to continue to thrive. Now, the biggest wave of new supply, new apartment supply in decades will temper rent growth and improve affordability for renters in 2024. But what needs to be understood is that again, that supply in apartments is actually focused primarily in luxury class A and some B class apartment complexes. Not for that affordable housing, that B minus to C class housing. There's not enough supply to meet the demand, and there's going to be there continues to be a need there, as we were just talking about a few moments ago, for those folks in the single family world who cannot afford to purchase their home or rent that home, that single family home. These people need roofs over their head, and the apartment building solution is what they're more than likely going to look for. The hotel industry will continue to face headwinds. There's a lot going on there, but if the economy slows, if there are fewer Americans traveling internationally or domestically, that may have impacts. But there is a possibility of there's less international travel and people choose to stay home and and travel, domestically, then the local domestic markets will be able to benefit from those things. And then data centers, all of the things that we all rely on every day, being, all the data that we're served up to the data that's used to serve up your Netflix subscription, to the data that's that's fueling the algorithm about what shows up in your LinkedIn feed or my Instagram feed, etc. All of those data require those companies require large centers to organize and contain and manage all that data, and these data warehouses are popping up around the country as well. So that too looks to be a very strong and attractive investment opportunity for those looking at those types of opportunities. But when we look specifically at the multifamily real estate market outlook, the multifamily outlook is strong. The primary reason for this is because the cost to buy is substantially higher than the cost to rent in most markets. And so one of the reports that I looked at, to prepare this presentation, is a report from the visualcapitalist.com. And essentially, according to them, they speak to the fact that home values spiked as millennials entered their prime buying age during a period of ultra low mortgage rates. And the federal funds rate was increased, as I mentioned earlier, 11 times to slow inflation, which simultaneously increased the cost of home ownership. Now, and I may have touched on this earlier, but in the case that I did not, according to Redfin, the typical home in the U.S. costs 25% more to buy than to rent. Let me just hit that one more time. according to Redfin, the typical home in the U.S. costs 25% more to buy than to rent. However, according to CBS News and CBRE, the data show that it's 52% more expensive to buy a home than to rent an apartment. So that difference, that right there is one of the key things. It has never been this high before, and that does not include things like insurance, maintenance, repairs, and all the other things that go into home ownership. And so it is not necessarily an incentive for people to be out there trying to go and acquire their first home or their next home when things are so dramatically expensive and not looking to come down anytime soon. And so there, as I had mentioned earlier, there are reports that there's going to be some oversupply in some of the apartment markets that may improve affordability for renters in 2024. But and there is some expectation that rent growth in markets on average across the markets will be weaker than expected at 1.2% expected in 2024. And that's despite near-term economic weaknesses and vacancy rates that will rise further above their pre-pandemic averages in 2024. And there's enough demand that should keep the average occupancy rate in apartment complexes at about 94%. And so developers, by the way, have correctly anticipated where demand will be, where it will be best, I should say, to support the new supply based on job growth. So they're paying attention to what's happening in the marketplace and where supply is needed. Where are all of these major corporations moving to attract talent to come and work for these companies? And they're looking at places like the ones that we've all been reading about for what seems to be decades now: Austin, Texas; Dallas, Texas; Nashville, Tennessee; Atlanta, Georgia, have the highest job growth projections. And with those, where the jobs go, so do the people, and so do the developers when they see those opportunities to be able to supply the housing that's needed there. Now, housing shortages remain. Multifamily real estate is playing a pivotal role in alleviating the shortage of the severe housing shortage. And like I said earlier, there are various different reports, but on average, what you'll see anywhere from 3 to 5 million units of single family homes that is contributing to home ownership. There's a shortage of about that many units that's contributing to home ownership challenges. And particularly, as I mentioned earlier, the higher interest rate environment makes it even more difficult to acquire their home. And then the premium for an average monthly mortgage payment of a newly purchased home versus an average monthly rent is expected to remain above 35% in 2024. So versus 52% in 2023. And so many markets in the Mountain West and in the Sun Belt regions are expected to continue having negative rent growth through mid 2024, which should bolster some rental demand in attracting that in-migration, that influx of people that are coming in. And so for those investors with these type of softer fundamentals in place and higher borrowing costs, they have negatively affected property values and create a significant buying opportunity for those opportunistic investors. So with investment activity expected to remain muted in 2024, investors have an opportunity to consider their long-term investment strategy. So for those investors that are looking for a little bit more of a longer hold, period, they could be in a market that where these assets have a little longer life cycle, if you will, with a similar investment horizon. The regulatory environments that play a huge role in this as well. For those who are really paying attention out there, we talk about the Sun Belt markets for a reason. These are really strong markets, and they are very favorable for investors because they have landlord and tenant laws that are favorable for investors. They also are very business friendly environments, where the taxes are lower and favorable for which attract businesses to go there. That is not necessarily the case when you look at markets like New York, like New Jersey, Connecticut, like California, and some of the other coastal markets, which present different challenges, and therefore corporations choose to move to these other places where they can have top talent and pay, potentially less taxes, and be granted opportunities that are very advantageous for them to continue to contribute to their bottom lines. We're also serving in their need in their communities, and so the market selection and underwriting for investors will be very important. And it may become a little bit more complicated when you have to factor in those variables that are going on there. But it's really important that you think through things. The other that variable that's happening out there for those investors that are investing in those areas that are subject to natural disasters. Think Florida, for example. Though the cost of insurance in coastal states and in coastal markets, these are very dynamic right now. Sometimes can make deals very unaffordable. These are things that people really need to pay attention to as you sharpen your pencils and you are analyzing deals going into these markets. And so, if you're preparing to invest, what I wanted to make sure that I could do is arm you with the information that I'm sharing with you at a top level right now. And you, of course, do your own research. But one of the things that's really important is, for anything, whether it's a great market or whether it's an okay market by anyone's standards, you always want to be prepared for opportunities that will present themselves. Savvy investors know how to make investments work in any market. And so, what type of investor are you going to be? And I will briefly cover this slide just simply to say, what for many investors, they look at real estate as an opportunity to diversify their portfolio. Many of the investors that are in my community come from traditional investments: stocks, bonds, mutual funds, 401ks, IRAs. Some people play with crypto and all those types of things, but the volatility and uncertainty of those things are not necessarily attractive. But when you look at real estate and its historical presence in wealth building and the consistency that it provides, those are the things that really are attractive to investors, and why they can really consider diversifying into real estate to be able to have a more balanced portfolio, one, but really look at the positive aspects of building passive income, to be able to legally reduce their taxes, to be able to help take advantage of those appreciation gains and hedge against inflation. And one of the things that I love to talk to investors about is that there are so many ways that they can invest in real estate. I will tell people often that I've invested in real estate using everything on this screen except for two ways. One is the self-directed IRA, and the other is joint ventures. But everything else I've done, and what I'll talk to you a little bit about for those people who are thinking about investing in their next deal or their first deal. Here's some things to consider about this. And so, cash, for example, as inflation increases along with the cost of goods and services, strong demand, apartment owners are able to increase rents to keep pace with inflation, all while the property is appreciating in value. So for those cash investors who maybe have a big nest egg that they're sitting on in their savings account somewhere, and you're looking for opportunities to put your cash to work to beat or hedge against inflation and to generate a return in an asset that's backed by real estate. You consider as a part of your investment strategy and talking with your investment advisors, consider putting some of that cash to work into real estate investment opportunities that will help you take advantage of the markets and the opportunities that inflation, that rent increases and appreciating assets, can provide for you. The other thing to consider for those people who maybe did during the pandemic take advantage of home equity lines of credit or home equity loans, and were able to tap into that untapped equity within the four walls of their home. Those folks, for that didn't go out and buy the boat or go out and and that put that money into some consumer item that is depreciating in value. There is something that's called an arbitrage play where many savvy investors can borrow that home equity and invest it into real estate opportunities that will generate a return that is higher than the rate in which they are borrowing, and then the delta of that is what is returned to you as an investor. And so this takes a little bit more of a sophisticated approach. And so there are some watch out here's around the fact that HELOCs are tied to the prime rates. And so as the Fed increases rates or decreases rates, these are things that you want to be mindful of if you're considering this type of an approach. But when done properly, you can very well take that equity in your home, invest it in another appreciating asset that is generating cash flow, and then continue to that cash flow continue to go to you, and then continue to rent and repeat that process as you continue to build equity, build assets, build cash flow throughout the different investments that you get into, just as something to consider. Now, another way that folks look at in considering investing is through retirement funds. Many people don't know that they can invest in real estate with their retirement funds. And so I love this particular opportunity because it gives me an opportunity to share with folks that, yes, in fact, you can invest in real estate with with either your self-directed IRA or your solo 401k, or what myself and I know others on the call and others listening may be familiar with the EQRP as an investment vehicle using your retirement accounts. And so for those folks who are self-directed IRA investors, or real estate, you can invest in real estate using your self-directed or SD IRA that it's commonly known as. And so there are this tool allows you to invest in real estate. It has some tax-free or tax-deferred account options. It is a protected investment, but one of the major things that takes place when you invest in a real estate venture that is financed using debt or leverage, there is something that is called a UBIT tax, also known as unrelated business taxable income. And this tax would apply to a percentage of the income or any gains generated from the investment that is attributed to the non-recourse loan. And so there are different ways that people may be able to navigate through this, and you would want to consult your investment advisors about this option and whether or not it's something viable for you. But I have many investors that use a self-directed IRA as an opportunity to invest passively in real estate to diversify their investment portfolio in that way. Another way that folks do from a retirement account perspective is that they utilize a tool called the EQRP Solo 401k. And this tool essentially allows you to have what they call checkbook control of your retirement account. And full disclosure, this is one of the vehicles that I use from a retirement account perspective to be able to invest passively in deals and diversify, my portfolio into real assets. And so the company sponsored 401k and all of those things are doing what it does. But then I have this tool and this vehicle to utilize to invest in real estate opportunities, to be able to diversify and outside of the financial markets. And some of the beautiful things about that in comparison to the SDIRA is that the SDIRA, it does have a custodian where you may have to get approval from that custodian to be able to make certain investments, whereas in the EQRP, you do not. You have control to determine what you are going to invest in, and 401ks, and also they have higher contribution limits. They with the Roth contribution as well. There you can roll over your old company sponsored 401ks or other eligible funds into this. And as I mentioned before about the UBIT, which the SDIRAs are subject to, the EQRP is not subject to this. And so this is something to keep into consideration as you think about that. And many of my investors use that vehicle as well. Cash value life insurance is another savvy way that people invest in real estate. And it's very similar to the concept that was shared earlier around home equity lines of credit. The pure concept here is that you would have a specifically designed and especially designed tax value whole life insurance policy to protect you and your human life value in the event of your passing. So there's that protection. But that aside, the cash value in that life insurance policy is something that you can borrow from, no questions asked. You can take what's called a policy loan from your cash value life insurance policy, and that policy loan is somewhere in the range of 4% and 5% or 4% and 6%, and you can borrow at a 4% and 6% from your cash value life insurance policy, all while the cash value is built, continuing to compound interest, but you're borrowing from the insurance company at a 4 or 5% interest rate, and then you can then invest that cash value into a real estate asset that's generating an 8 or 9% return. The delta between the two is what your return is, and then that is how you can again leverage that arbitrage play of leveraging your policy loan to acquire another asset, that's generating cash flow, that's appreciating in value, that's you're creating tax benefits and continuing to build and protect your wealth. And so that's something else to consider, another more sophisticated approach, but nevertheless something that you can consult your investment advisors about. And so, look, that was a lot, and I appreciate you guys hanging in there with me for this presentation. I know we had some issues with our speaker this evening, and we quickly pivoted. So I appreciate everyone hanging in there and allowing me to share here. But finally, just in summary, the U.S. single-family housing market will continue to be out of reach for many of the home buyers seeking their first home or their next home. This is driven by high home prices, but it's also driven by high interest rates and low supply and a high demand. As a result, the U.S. commercial multifamily real estate market remains a strong investment opportunity for people to consider. Investment portfolio diversification into assets that are backed by real estate can be a wise strategy for minimizing your downside. There are multiple options for accessing capital. I just reviewed several of them, and diversifying into well-bought real estate assets from operators and investors who can provide these opportunities to you is something that you should consider. And for those people who are interested in these types of opportunities, I would like to ask you to consider joining our investor club to gain access to any upcoming opportunities that we may have. There are other folks in our network here tonight and also in our community. Reach out to them. They have great investment opportunities as well. If it sounds like something for you, like I said, please reach out to me. I'd like to offer you a complimentary call, to join our investor club. The investor club really it is free first and foremost, and it is just an opportunity to receive helpful information about real estate investing, but also for getting access to great real estate investment opportunities for you to consider investing in. So if you'd like to reach out and tap into that, please do reach out to me via the information that I shared earlier. Chris at Red Fox Multifamily, or you can hit me up on LinkedIn, or you can go to my website, redfoxmultifamily.com. Finally, the sources that I used again for today's presentation was Redfin and also CBRE. These are two premier firms in the real estate space, both in single family and commercial real estate, and they were primary sources that I use to share with you this evening. So thank you very much for your time. I'm going to stop presenting and open it up for any questions or discussion.
I'm trying to Hey,
there
Chris,
you go.
great.
I got you.
Thanks, man.
Enjoy. Thank you, Tom. Thanks for hanging in there. I appreciate it. I apologize for the delay earlier, but thank you for staying on.
Yeah, man. No, it's good. It's good. Good information for sure. I was curious, like, what class of apartments are you focused on these days, and what markets?
Yes, I'm focused primarily on that A and B class apartments. I'm focused on the Sunbelt markets primarily, but we have a very deep focus in Texas, specifically Dallas, Houston, and those metro areas. I'm also very bullish on the Carolinas, specifically the Piedmont Triad. So think about Greensboro, Winston-Salem, High Point. Those areas are areas that I want to make sure that we can focus on as well. And we're looking at 100 units and up in terms of our focus.
Okay. Yep. Got it.
How about you?
Yeah, mostly for me, it's anywhere I can drive in about 4 hours from Knoxville. I like to kind of provide boots on the ground for our group. So I'm looking, mostly what I'm looking at right now is, Louisville, Lexington, Knoxville, Chattanooga, all the way over to Charlotte, all the way over to even Nashville, Huntsville, Alabama. So that's kind of my focus area right now. I'm finally starting to see a few off-market deals, but nothing I'm underwriting lately. It's panning out real well.
Yeah, but at least you're getting some off-market supply, which is really good.
Yeah.
A lot of deals that end up going live don't necessarily pencil out, and then you end up competing with stuff, and those are the things that I really try to stay away from at this point in time. I prefer, and so when our focus is partnering up with the best operators who are got that lead flow, that deal flow, I should say, that have those deals coming in, and that increases the likelihood and the opportunity for the deals to come off market, and then therefore present some great opportunities for us to partner up with them and connect our investors to those deals.
Yeah, good deal. Well, if there's anything I can do to help you out over in this region, let me know. I thought it was a good presentation for sure. I enjoyed it.
Well, thank you very much. I will, this recording I'll send out, and I'll tell you there is there's going to be making some announcements soon, so you'll have an email from me, about some great opportunities that we have coming up, and I'm looking forward to, there would likely be an opportunity for us to expand our focus into the markets that you're playing, and you some of the places that you are in, you're touching, and and poor markets and really that primary area there. And there's a lot of interest there. So I'm sure we'll be in touch.
Yes, sir. Sounds good.
Well, thank you. Does anyone else have questions before we drop off this evening, or comments? Well, if not, I just want to thank everybody for taking the time out. I know, again, we had a little bit of technical difficulty, but I appreciate your patience and us working through those things. I always appreciate seeing everyone come out. And for those who weren't able to attend live, obviously I'm recording this. This will go out to the membership. I'm so grateful to have over 1,000 members of the Meetup. We have a pretty good YouTube following too that go back and look at our recordings. So this will be yet another one added to the library so people can consume the content. But thank you, everyone. Have a great rest of your night and take care. See you, Tom.
Amen. Thanks.
See ya.
Thanks, Chris. Have a good night.